What is up, everyone? Today we are going to be dissecting GME and particularly my exchange on Twitter with David Hanlon. David is a super nice, awesome guy. He is the laptop legend. You never want to mess with someone that is a legend, especially if he has his laptop in hand, but we're going to do just that. And so what happened was David had an original post that he had kind of chopped himself up in GME off the open on 5-9, and then he ended up sitting out for the real breakout. And I commented that this is in according to me and my framework that he was trading in no man's land, and avoiding that can really help you stick around for the real move. David had a very thoughtful response back explaining how he traded and his reasoning, and I think we're going to dive a little bit deeper into that. And so what David said is, I almost always position into breakouts during consolidation when I'm pretty convicted in a big move because I can't get size when the risk level is almost 4 times as wide. So just stopping to break down that sentence, I would say with this stuff, the devil is really in the details. For anyone that knows me, like, the nuances always matter. It's really hard to have too many hard, fast rules because the situation really matters. And so I almost always position into breakouts during consolidation. And so I would say just on that, like, I'm not necessarily opposed to this, but it really depends the quality of the setup, the quality of the consolidation, what the liquidity looks like. Will I not be able to get the liquidity that I'd otherwise want when it does break? And the other thing to keep in mind, and this will come out a lot when I go deeper into this video, is a lot really depends what time frame you're operating on and through kind of what system you're using to capture the right risk reward. Because there are times when it sets up properly and well for at least my system, like intraday, you can get some super incredible asymmetric risk rewards, and you don't need to risk 4 times as wide. So David goes on to say, on GME, buying opening, excuse me, opening range high breaks this morning, I think there was a reasonable chance of catching the breakout and a move to $20 with about 50 cents of risk low of day. If I'm buying 1730s to 1750s when it finally breaks the no man's range, I have nearly $1.50 to $2 per share of risk. He prefers the tighter risk reward and the worse win rate, especially when the level can be stuffed. So let's dive into this a little bit. So first, I always like to start with the daily chart and provide some context. So GME kind of perked up on 5-2. We then had a really big day, almost somewhat blow off intraday on 5-3. And then we proceeded to form inside bar after inside bar after inside bar, which pretty much turned into a traditional kind of wedge flag pattern where the bars were holding prior day lows as well as prior day highs. And so I argued that as far as avoiding no man's land, in general, on basic technical analysis, I want to be short if we break to the downside of this wedge. I want to technically be long if we break above that wedge. And so, again, that's at least just the potential for me to position. Even, like, I'm not going to blindly just do that. There's so many more nuances on the quality of the setup, which we'll get into. But for now, I just want to point out, like, 1530 or so was the lows here, and 1725 or so was the highs of that bar. So those levels will become important. And now let's jump into the actual intraday action on 5-9. So I will be making some assumptions about David's trading. He gave me some details, but obviously, like, it's not as if I'm looking at his chart. Like, this wasn't super granular, so you know, I could be wrong on this. So my understanding is he said buying the break of opening range highs. I would assume when he said risking 50 cents and doing that, I assume he means he's buying 1610 or so here and giving to these lows. It adds up mathematically, and that's just my best case, but I'm not certain. So if I'm wrong, you know, so be it. I would also then guess what that means is he got stopped out here at around 1130. Again, I'm not super certain, but that's kind of what it sounded like. And so he argues that giving this 50 cents, there's a chance you can capture a 20 plus move. And so what I would also point out, though, is buying at 1610, that saves you essentially an extra $1 of reward against the otherwise, daily breakout to the upside. And that lowers your risk from 50 cents to much lower depending how you structure it. And so my issue though is I would argue that even though you get a better risk reward, buying smack dab in no man's land lowers your win rate to the fact that I'm not surprised that he did kind of eventually get stopped out. Like, I'm not so surprised that this didn't break at this time. What I would really say though is it's really hard for me to handicap the probability of this trade working. And when you get some of those more skewed risk rewards, like if you say something is, okay, I'm risking 50 cents and I could make, 20 plus. So maybe I make 8-to-1 risk reward or something like that. So 8-to-1 risk reward, that's going to break even at roughly a 15% win rate. But once we start to talk about some of those extreme cases, for that to be a break-even trade, it's kind of really hard to handicap this. How many times will you get stopped out and lose the 50 cents versus otherwise? I kind of suspect it's maybe marginally positive expected value, but I'm going to get into some further points about why I think it's so marginal, as well as some other implications though of this trade. And so the biggest point I want to make, and I think is most important for David, because if he has a system that works, that's great. The biggest thing and the most important point of no man's land, and the video I made, which I'll post when I post this video, the point I make is that so many traders end up chopping themselves up in no man's land where it's lower probability, that when the actual break comes, they either have very minimal size or no size and kind of miss the actual trade that they were positioned for. And I've seen it happen so many times. I've made that mistake so many times. And I would argue to David that, okay, let's say you're right and this is positive expected value. I would still argue then, if you're taking yourself out of the game before it actually breaks, then you were probably oversized here. So if you must do this trade, I would argue the big lesson is just your sizing. Right? Because again, if we're saying that this is, in my opinion, not super probable that it trades cleanly, you need to give yourself a couple bullets, a couple strikes. And at the least, you always want to keep that one in the tank so that when the true break does happen, you're there for it. So David had also gone on to ask me, what level would I have been buying? If you do the prior bar break on my 2-minute bars, it would have gotten stopped out anyways. So kind of hey, Lance, what's the deal here? How would you have done it if you think there's a better way? And so one thing that I think is important is you want to segregate, at least the way I do it is my intraday trading is different from my swing trading. Ideally, the intraday and swing trading aligns. Those tend to be the best setups where the intraday and the daily align so well. So like I argued, I want to see a break of 1725, but you could even argue 1750 for the true break of that daily range. And so here's my issue. By the time we actually break 1725, I would argue this intraday didn't set up that great against 1725 or 1750, right? The equilibrium price throughout this whole day is about $16, and the intraday breakout is what, 1650-ish? So 1660 or so. So we have actually already covered a fair amount of distance and done a pretty fair amount of volume into that. And so this intraday isn't actually that enticing for me. I wouldn't have sized that big. So yes, it does stop me out on the 2-minute bar chart, but I wouldn't have really necessarily loved this. Even if I would have gone for it, it would have been smaller size. The other thing too is I think how you structure this is kind of important, where it's one of those things where because this could have large asymmetry, yes, the calls are jacked up, but it's worth considering if the setup isn't that great and you're otherwise going to take a couple paper cuts, maybe you do just want to risk a certain amount of premium into the options. I would almost argue for David, rather than taking this trade with the 50-cent stop, I almost wonder, would it have been better to put a couple grand into call options while volatility isn't super insane, and just given that to the proper daily stop of 1530 or whatever it was. that's one thought to consider, just because I think you get much better asymmetry to justify the low win rate. And even when that breaks on this intraday, I think that's worth considering. But so the overall point I would make is this didn't set up that well for me. And so what I would have really liked to see is almost like the VVOS intraday consolidation. Like I would have loved to see this run from 16 to 1725 or so. We then consolidate all day, we start to pull in, we get tighter, boom, then we break. And so the beauty of that, when it sets up really nice intraday, that's where you can define your risk so tight. And I don't need to risk to the bottom of that bar because I'm making an intraday setup trade. For me though, there was no intraday setup here. So that then begs the question, okay, Lance, like what about a daily setup? And so I think it's totally okay to buy this break as a daily setup. I don't love it because the risk is pretty big. And so here's some points I'll bring up for the daily, and that's going to also bring back to David's original trade, and why I think it's kind of wishy-washy. And so if we look at this setup, in true technical analysis principles, which I think largely for the most part hold true, we want to buy close to support, right? And so in this wedge, these prior bar lows are support, and the prior bar highs are resistance. So in theory, we want to buy as close to support as possible. We want to sell into resistance, and we want to buy back above the resistance if it breaks. And let's say this range was simply $10 to $11. You don't want to buy 10.50, right? It's smack dab in no man's land. And so where he ended up buying like that 16.10, I would argue it's just a little bit too close into the middle of this range of the bar, where like your stop is your daily support is a little bit less than $1 away, and the daily resistance is a little bit more than $1 away. So from even a daily swing, it's just too in the middle of the bar, and that's why I think the probabilities are kind of just too wishy-washy for me. The best analogy I would give, so like, well, let me take a step back. So even on the daily perspective, like if I buy this break, if I'm doing a daily swing trade, I need to generally give it to those lows, which is about $2 of risk. Yes, this could go $4, $6, $8. I think the odds are like somewhat okay, right? We did reach 20 and had kind of a hard reversal, but even the $2 of risk, I don't love this so much. So even from the intraday, which I definitely didn't love, but is maybe worth a small stab, I feel kind of the same way about the daily swing, where it's like, if I was short and this breaks, I'm definitely covering that, but do I want to long this against those lows? I don't love it either. And so now let me jump quickly back to this intraday kind of for my final analogy. And so what I would say with all this is the equivalent. Like, I do think this setup had a lot of potential. I think it's almost like you get in poker ace king. But it's not so much just the potential of the setup, so much as then how does that hand actually unfold and all the nuances around it. Like, what position are you in, what chip stack, how has everyone else been playing? And I would argue that the way this actually set up, despite the potential, it's like you have ace king, but then the poker hand, the flop happens, and on the board is like 9-7-6 suited. All of a sudden, your ace king that had a lot of potential ends up not so good, and you need to adapt to that. And so the way I view this is like, this daily setup had a lot of potential. I was definitely watching it, but like from an intraday perspective, it didn't set up so great for me. I don't really like, especially this part, how we fail and go to lows and everything. And then even from a daily perspective, it really wasn't so tight or so beautiful anywhere. So a lot of this ended up being a no trade. Like, I actually didn't take any trade for this either way. And that's why I think, though, for David's case, like, if I could just impart one lesson overall, it's not, I don't have any strong view on, I don't think this trade was great. I don't think it was bad. But the bigger point is, regardless, you don't want to knock yourself out of the game for the actual break. Like if this set up super, super well, which again, I don't think it did, but if it did, you can't afford to let these paper cuts let you miss the super good setup. And this is a point I demonstrate really well in the S&B Capital video that I'm going to post. I hope this overall explained my thoughts. And yeah, any questions, let me know. Hope it helped, and happy trading all.